No one can control the stock market or exactly how an investment will perform, and feeling a lack of control can lead to making emotional and impulsive investing decisions. So even though we're trying to avoid potential declines, the biggest risk to our investment success may not be market fluctuations themselves, it's our reaction to these fluctuations. However, if we were to identify and understand emotional investing behaviors, we can help to avoid making these mistakes in the future. For example, one mistake is trying to time the market. Remember that in order to reach your long-term financial goals, it's important to stay in the game and not head for the sidelines. On any given day, you'll see negative headlines about the economy, political uncertainty, or market fluctuations. And while it can be tempting to move to the sidelines and wait for things to get better, it's nearly impossible to successfully predict when to exit and re-enter the market. Unfortunately, many people tend to invest based on their emotions, selling after declines, and then missing positive market moves. And the effects can be dramatic. Consider this. In a study observing investor behavior, investors with a balanced portfolio of 65% in equities and 35% in fixed income over the past 20 years would have averaged about an 8.6% return per year. However, the average US investor received only about a 3.7% return per year due to his or her investing behavior. They tried to time the market, buying when they felt good, and they sold when they felt bad. Now, another common mistake is chasing performance. Investors are always hearing about the latest hot investment, which can lead them to chase performance, buying what just did well, or selling what is currently out of favor. This type of emotional response can lead to buying high and selling low, certainly not a recipe for a successful investment strategy. Ultimately, investments tend to outperform and underperform at different times, which is why diversification is so important. We can't predict the future, but we can prepare for it. Owning a variety of asset classes and investment types can help smooth out the ups and downs of the markets, which sets the stage for a better long-term experience. Now, one final common mistake is focusing on the short term. Some investors can become fixated on a certain point in time when measuring their investing success. And depending on the vantage point, the same situation may look very different. For example, many investors sold in 2008 because their portfolio had fallen from that all-time high value. They did this even though their performance may still have been on track to meet their goals, and it may have been well above their starting point. Understanding that market declines, while uncomfortable, are normal will help you keep realistic expectations for investment performance. The stock market averages a 10% decline or a correction every year, so it's important to measure performance as progress towards your long-term goals, not short-term market distractions. Now, avoiding the impulse of emotional investing requires discipline and perspective, having a clear picture regarding why you're investing, as well as how your decisions may affect your ability to reach your long-term objectives. So if you feel your emotions starting to get the better of you, take a step back and talk with your financial advisor. Working together, you can stay focused on reaching your financial goals.